Welcome back to another video here at Fiscal Voyage. I'm Felix, and in this video we're going to do a stock analysis on Eaton, Vance Corp, which is suggested by Diedrich. Thanks Diedrich for suggesting this video. Normally when people leave a comment and requesting a stock analysis on a video, I normally go in order. But Diedrich messaged me on both YouTube and on Facebook, so I was like, man, this guy really wants me to do this, so I'm gonna do it for him. And he basically skipped the line. But thanks Diedrich for hitting me up and subscribing to my channel. So we're gonna do a stock analysis on Eaton Vance to determine if at current prices it is worth a buy or even sell. We're gonna see the fundamentals, how is it doing, and where is it going. So stay tuned to the end of the video, and I'm going to provide a fair value price and my recommendation. So let's get started. Okay, here's the stock analysis on Eaton Vance Corp, ticker symbol EV. The company is one of the oldest investment management firms in the United States with a history dating back to 1924. It's primarily an investment products it provides to individuals, institutions, and financial professionals. And it's mostly focused on active management rather than passive. It's not a wealth management company. It's more investment management. So let's continue with fundamentals. Revenue grew at 4.6% from 2010 to 2019, which is okay. There's other financial companies that grew at a higher rate of revenue. Net income, however, grew at 9.7% at the same time period, which is much better. And earnings follows net income with a 9.3% earning growth from that 10-year period. S&P has a credit rating of A-, which is investment grade, which is great. And operating income been basically flat in that 10-year period. However, net income in the past 5 years has been averaging at 14.8% compounded, so that's really good, as well as earnings growth for the past 5 years been increasing following net income at a little lower rate at 10.8%. Fundamentals, 2019 earnings came in at $3.45, net margin at 23.8%, which is higher than 2018 net margin of 22, slightly higher here. Return on equity at a nice rate of 34.9. Debt to cap is modestly high at 63%. Currently, the company has an attractive dividend yield at 4.44%, which is pretty good, finding a dividend yield at this rate. And the dividend is safe at 48% payout ratio. And the company has been growing dividends for 39 consecutive years, which is outstanding. 39 years, even going through the financial crisis, it raised its dividends. In 2008, 2009, which was very rare for financial companies to raise dividends during that time period. The company has a nice dividend, 5-year dividend growth rate of 9.4%. The most recent increase was 7.1% of last year, October 2019. And the company has a dividend yield average of the 5-year dividend yield average of 2.81%, which is much lower than the current yield. So basically you get the company double the yield than its 5-year average. But that's something interesting I'll talk about later about that. Charter rule has 13.8, which is the 5-year growth rate of 9 plus the current dividend yield of 4.44, which is pretty good. You like to see company 11 or 12 and higher for the charter rule, so that passes that criteria. Future outlook, analysts expects for this year earnings to be at $3.08, which is lower than last year, $3.45. Of course, with the coronavirus pandemic shutdown, so earnings looks to be dropping, and 2021 looks to be a little higher by a penny, because CFRA is projecting earnings growth of only 1% for the next 3 years. So earnings is going to be flat. Which is not a good thing. I like companies to grow earnings, about at least 4 or 5%. But here, Eaton is having flat earnings. During my dividend yield return model, projected total return of 9.7%. So it meets that criteria of at least 9%. But at this time period, there's a lot of other companies that you're getting 11-12% projected return. So that's something to consider here. Currently, the current PE is 10.4 and the forward PE is 10.9. Obviously, that's because the current PE is based on last year's earning, and the forward PE is based on this year's earnings, and it's going to be lower, so that's why we have a lower forward PE. I like to see it the other way, where current PE is higher than the forward PE. This way is the opposite. But based on the 5-year PE average, the company is much lower than their 5-year PE average of 15. So that's something positive there. If we look at the fast graph, the black line, the monthly closing price, the orange, the earnings with a multiple of 15, and the blue is the normal multiple PE of 16. As you can see here, the company fluctuates between both the orange and the blue, so I would consider fair price at a 15 multiple, as we saw with the 5-year average in the last slide. So based on this, the company is undervalued based on the fast graph. But if we look at other analysts, CFRA has a target at $52, Morningstar at $37, fast graph, as we saw, $46.20, Yahoo at $34, and my dividend discount model analysis at $32. If we average out to 5, we get a fair price of $40.48. Currently, the company goes for $34.26, which means it is undervalued by 18.4%, or 18.2%, excuse me. Therefore, I have a buying recommendation for the company. I love the dividend history of 39 consecutive years. However, I do find other financial companies to be more appealing currently. I'll get to that later. But during the financial crisis, this company did not cut its dividend from 2008 to 2009, which was great. I highly doubt that the company is going to cut their dividend this year or even next year because of the coronavirus. So the dividend looks very safe and a nice 4.4% yield, very attractive. There is upside in the company, as we saw, is undervalued at 18%. But I think there's a lot of things to consider as well, because analysts expect flat earnings. So, but it is going to pick up in maybe 2 or 3 years. But I personally think there's better opportunities. For example, AMP or TROW, TROW. I think those are better opportunity at current price and at today's market. But you know, EV has the potential to continue growing the price because of the valuation and the dividend yield, but not based on earnings growth. So that's something to consider there. But I still recommend it as a buy. But again, I'm not investing in it because I think there's better opportunity in AMP and TROW versus this company. But make sure you do your own research and come with your own conclusion. With that, if you find a company that you would like me to do next, a ticker symbol and the company name on the comments, please let me know. And thank you for watching. If you find this video informative, please hit the like button and subscribe to my channel for more videos like this. And you can check my portfolio in the link in the description below. Thanks again and stay safe.